Hello, and welcome to All About Business, here where we talk about everything business related, whether finance or other things. And today we are actually going to go over a definition, which is going to be audits. Now, a simple definition. An audit is the term audit usually refers to a financial statement audit. Some examples include number one, the Internal Revenue Service selected us for an audit. Two, you will need all your records if you are selected for audit by the IRS. Or three, they audit company books every year. Now, there's actually three types of audits. The first one is external audits. The second is internal audits. And the third is Internal Revenue Service, also known as the IRS audits. Now, to go over them, we're going to look at external audits first and foremost. Now, audits performed by outside parties can be extremely helpful in removing any bias in reviewing the state of a company's financials. Financial audits seek to identify if there are any material misstatements in the financial statements. An unqualified or clean auditor's opinion provides financial statement users with confidence that the financials are both accurate and complete. External audits, therefore, allow stakeholders to make better, more informed decisions related to the company being audited. External auditors follow a set of standards different from that of the company or organization hiring them to do the work. Now, the biggest difference between an internal and external audit is the concept of independence of the external auditor. When audits are performed by third parties, the resulting auditor's opinion expressed on items being audited, also known as a company's financials, internal controls, or a system, can be candid and honest without it affecting daily work relationships within the company. Now for internal audits. Internal auditors are employed by the company or organization for whom they are performing an audit, and the resulting audit report is given directly to management and the board of directors. Consultant auditors, while not employed internally, use the standards of the company they are auditing as opposed to a separate set of standards. These types of auditors are used when an organization doesn't have the in-house resources to audit certain parts of their own operations. The results of the internal audit are used to make managerial changes and improvements to internal controls. The purpose of an internal audit is to ensure compliance with laws and regulations and to help maintain accurate and timely financial reporting and data collection. It also provides a benefit to management by identifying flaws in internal control or financial reporting prior to its review by external auditors. Last but not least, we have Internal Revenue Service IRS audits. The Internal Revenue Service, also known again as the IRS, also routinely performs audits to verify the accuracy of taxpayers' return and specific transactions. When an IRS audits a person or company, it usually carries a negative connotation and is seen as evidence of some type of wrongdoing by the taxpayer. However, being selected for an audit is not necessarily indicative of any wrongdoing. IRS audit selection is usually made by random statistical formulas that analyze a taxpayer's return and compare it to similar returns. A taxpayer may also be selected for an audit if they have any dealings with another person or company who is found to have tax errors in their audit.